Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, How to Generate Income with Options, we'll take a look at how investors can generate income from stocks they already own or plan to purchase with the covered call option strategy. As always, we'll cover the material, as well as your questions, in a quick 60-minute session. Our instructor today is a member of OIC's Investor Services team, Mr. Ed Modla. Ed started in the options industry in 1997, working with Blair Hull's trading group. After a number of years in the pits in both Chicago and New York, Ed traded independently and later transitioned to help investors and traders with both futures and options on futures. He joined OIC in 2014 and brings a special understanding of using options effectively, minimizing risk, and maximizing returns to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Ed will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now using the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And OIC has a few live events left in its fall evening seminar schedule. Tonight, if you're in Costa Mesa, California, or Edison, New Jersey, we have sessions in your city. And tomorrow night, we have a session on option trade management in Bellevue, Washington. Sign up at optionseducation.org. And now, ladies and gentlemen, Ed Modla will bring you our topic today, how to generate income with options. Ed?
Thank you very much, Nick, and welcome everybody to our presentation today. As Nick said, Generating Income with Options is the title. Specifically, we're going to talk about the covered call strategy, its components, and talk about the risk-reward attached to this spread, some motivations you'll have and some hesitations you might have when you put on this spread, and what your final results will be with respect to return calculations, profit and losses. We'll get into some numbers and some detail as we go through. First things first, we're going to go through our disclaimer. Options are not suitable for everybody. There are unique risks involved when trading options. The characteristics and risks of standardized options is a booklet that's required reading for anyone that's going to get approval to trade options in a live account. You can contact your broker to get that booklet. Also, we're going to go through some computations and return calculations today. These computations will not include the costs of commissions, fees, margins, or taxes. Those are relevant costs in a live account, but to keep things a little more simple today, we will not include these particular costs. For those of you who are new to us, you might be wondering who the OIC is. Well, we are at the forefront of equity options education. All of the exchanges and the Options Clearing Corporation, or the OCC, fund our efforts. So that is the educational website that we provide, optionseducation.org, and the maintenance and updating of that website, along with all of our events, including this webinar presentation today, is able to be provided and put on for the users free of charge because of the funding provided by these entities. Of course, they all have a vested interest in seeing that options are used effectively and wisely, and also would like to see an increased use of options as we move into the future. Speaking of which, options volume in recent years has experienced a tremendous uptick. As you can see here, a huge amount of growth in the options industry has been experienced recently. There's any number of reasons why this has happened. But certainly the advent of electronic trading is a big part of that. The speed and access to which options are now available to investors has greatly increased. But also we've noticed that investors and advisors are taking a much more proactive approach towards managing their portfolio, specifically when it comes to risk management and generating income. And that's where options can really be beneficial to the investor. Also, there's much more of a widespread knowledge and comfort level with options due to the kind of educational materials such as the ones we provide out there available to the public. So now let's go through our presentation outline for today. By the end of the presentation, you'll know what a covered call is, what the components are, what the risk-reward profile looks like, and we'll go through some calculations. Return calculations are very important when you're going to analyze a prospective trade or analyze a trade you've already done. And then towards the end, we'll speak from a more conceptual point of view about the importance of planning your trades, sticking to the plan, and then some common misconceptions that you may have heard or you might hear about the covered call specifically. We'll go through a handful of those and dispel those and put those to rest. So before we get into the specifics of the covered call strategy, let's take a broad overview. Generally speaking, before the options trade exists, your market outlook has to come to the forefront. So whether you're bullish, bearish, or neutral would happen first. You do your strategy and your analysis and come to that conclusion, and then the option trade fits. You choose the options trade that best fits your narrative. So the covered call is best suited for a market outlook that is moderate, bullish, or neutral. So slightly bullish or neutral in the underlying or in the market. Your purpose or your goals would be to increase the income in your portfolio or generate greater returns, specifically above and beyond what you would return if you just own the stock. Now, with a lot of options trades, you have to gain something to give up something. You have a cost and a benefit. So with this potential increased income and benefit comes some kind of a cost. And in this case, that would be limiting your potential profits to the upside if the price of the stock rises. And we'll cover that through our examples, and that'll come through crystal clear a little bit later. But also, it's useful to keep in mind where your risks are, of course. And in this particular spread, your risk is very similar to owning the stock. So to the downside, if you are bearish, this might not be the best spread for you. So to summarize this, a neutral to moderately bullish outlook is what would best suit the covered call. If you're bearish or aggressively bullish or strongly bullish, then the covered call might not be the spread for you. Now let's get into the specifics. What does the covered call entail? Well, it's really two components. It is being long shares and short call options. Specifically, for each 100 shares that you own, you are short a call option. So if you're long 500 shares, you'd be short 5 calls, or long 1,000 shares, you're short 10 calls. Now, the other terms you see on this screen here, covered right, buy right, over right, they all refer to the same two components of being long shares, short call in that 100-to-1 ratio. But those terms are trying to distinguish when you put those specific sides on within the spread. For example, the buy right is a popular term. You may have heard it before. If not, you'll likely hear it as you're going through more education. The buy right specifically refers to buying shares of stock and selling call options at the same exact time. So you're executing a simultaneous order, which is in contrast to owning the shares and then at some point in the future deciding that you want to sell calls to generate income, which might be referred to as an overwrite. So you might see these different terms. They all refer to the same spread in its construction. They just refer to some difference in when you put the trade on each side, whether they were done simultaneously or at different times. So now we're going to talk about your motivations and some hesitations that you might have, what your advantages and disadvantages of the spread are, and break it up into 4 pieces. We'll take these slides one by one. So first of all, why would you do this trade? Well, there's really 2 major reasons. First of all, we said you want to increase the returns in your portfolio. You own shares, or you think that this underlying is going to be relatively neutral, consolidate, maybe move higher a little bit, but that's not going to offer you too much return in the way of positive income. So you decide the covered call is going to help you generate more income, specifically by receiving call premium. That premium is kept, inputted into your account when you sell the option, and whether you're assigned or not, that money stays in your account. So that specifically is the amount of funds, of money, that you're trying to increase the returns in your portfolio by. Of course, your forecast is neutral to slightly bullish because if the stock rallies sharply, you'll be under the obligation to sell your shares. We know what selling a call means. You're under the obligation to sell shares at the strike price. So if the stock rallies aggressively, you can't participate in that continued move higher. And that's why the forecast calls for a moderately bullish outlook on the underlying stock. Now, there's also another benefit here. You get to lower your break-even point on the spread. And let's think about that for a second. If you were to, say, buy shares of stock at $50 and sell an out-of-the-money call option for $1, doesn't matter what strike it is, you now have a covered call spread on. If that stock moves down by $1 at expiration, you've lost $1 on your stock, but you've profited $1 on your call option, which expired out of the money and worthless. So you've broken even though the stock went down $1. If you were just long shares, you would have lost that $1, but it moved down $1, or in this case 2%, and you still broke even because that call premium helped you out. So dual benefits here: increase returns and lower your break-even point. Now, what's on the other side? What are your obligations? Well, we just talked about that. Just like any call option that you sell, you're under the obligation to sell shares. This is something you know going into the trade, you're comfortable with it, and you understand that if you're assigned, you're going to have to sell your shares at the strike price, which means if the stock continues to move higher, you won't be able to participate in that continued move higher. You're willing to do that because in return, you receive premium. And that's the amount you're trying to increase the return in your portfolio by. So that premium is yours, and you're willing to accept the obligation to get rid of your shares and to sell them if the stock moves higher in order to capture that extra premium. Now, of course, we know equity options are American style, so this potential assignment could occur on any day up to the expiration date of the option. Now, the option spreads are frequently termed to be somewhat consistent with the construction of that spread. And you've heard words like strangle and straddle and butterfly, and they have some kind of meaning. A covered call is no different than that. It's useful to go through what covered means because it helps drive home what the spread is and helps you remember it a little better. And covered really has two meanings here. First of all, we know we have an obligation to sell stock at the strike price, and we own those shares in our account. So in effect, if we're assigned and called to deliver those shares, we already have them in our account to deliver. We don't have to sell anything short. We don't have to borrow anything. We have the shares in our account, and we just simply deliver those shares upon assignment. That means that the long stock position effectively covers our obligation, or you see here on the screen the word collateralizes is underlined. The long stock position collateralizes the obligation that we have on the stock position. So in that way, it's covered. There's another way it's covered too. Think for a second about the naked call option. Hopefully you're familiar with that. If you sell a naked call option, you receive premium. You're under the obligation to deliver shares at the strike price. If the stock moves higher, your potential loss is unlimited with the naked call. As the stock price moves higher and higher and higher, your call price gains value. You're short that call. You continue to lose money. But with the covered call, the long stock offsets that loss. As the stock price moves higher and your call option will experience greater and greater losses, your stock position will experience greater and greater gains. So in that respect, your long stock position covers the loss potential on your short call. So a naked call is considered one of the most risky options trades you could possibly do, whereas the covered call is considered one of the safest and one of the more conservative spreads that you can do. Now let's get started with our graphs, and these are always very valuable. We love looking at graphs here at the council. And this is a very simple graph, of course, comparing long stock to covered call. We have our stock price on the horizontal axis, and we have our P&L on the vertical axis. And as you can see with these two spreads here, first of all, long stock would be quite clearly losing money as the stock moves lower and gaining money as the stock price moves higher. Covered call looks similar on the downside. You lose and you experience losses as the stock moves lower. But notice a couple differences here. If the stock price stays right unchanged, doesn't move, of course your long stock is going to break even. You didn't make or lose anything. But the covered call will actually profit there. Remember, you sold a call option. Again, using an out-of-the-money example, you sell a call option out of the money, you receive premium. If the stock goes unchanged, that call option stays out of the money and expires worthless. You've received that premium and you keep it. So you'd be profitable if the stock doesn't go anywhere. Notice the break-even point as well. With long stock, of course, your break-even right where you bought the stock. But with the covered call, it's a little bit lower than that. Effectively, your stock price can move lower by the amount of call premium you received, and those two P&Ls would offset each other. The amount of money you lost on your stock would be offset by the amount of profit you gained on your call. Now, the difference really here, aside from those few things, is on the upside. With long stock, you're not encumbered by anything. If the stock moves higher and higher and higher, you continue to experience more and more gains, whereas the covered call does not participate. At the strike price, you are committed under the obligation to sell your shares. Therefore, as the stock continues to move higher, your profit cancels each other out on the stock and the call, so it flatlines. That's one of the limitations, is your limited profit potential on the covered call. So now let's summarize before we get into our first of two examples for today. The profit potential is limited specifically by the amount you could possibly make on the stock move plus the call premium received. We know the call premium is in our account. That's profit for us. That's going to stay there. If you sold, again, an out-of-the-money option, you could profit from the stock price moving from your entry point on the stock up to the strike price of the option. That difference would be a gain for you, and then at that point you're obligated to sell your shares. So your maximum potential would be for the stock price to move up to the strike price and have a gain, plus the call premium received be additional gain. That would happen if you're assigned and you sell your stock at the strike price. As we said earlier, the break-even point is also lowered. If the stock moves down by the amount of the call premium, you will break even. Your loss on the stock will equal out the gain on the call, and that's where your break even will be. Downside loss is termed substantial. You have some protection there with a lower break even point, and your call premium will continue to be a positive influence on your account, but only in a limited way. As the stock suffers and experiences losses, the downside potential loss will continue to increase in a similar way and similar fashion that the long stock position would. So hopefully you followed most of that. We're going to go through our first example and put some numbers on the board, and that should make things easier for you to understand. Let's look at company XYZ, which you own shares in. It's trading for $52 a share, and you've done your analysis on the market, fundamental and technical analysis, and you've decided that you are indeed neutral to moderately bullish, which means you don't think you can gain a whole lot with this stock position. You don't want to sell it. You're not bearish, but you don't think there's a whole lot to be gained by owning this stock. So you decide to generate some additional income, and you decide to sell a call option that goes out a few months at the 55 strike price and receive $1.75 for it. Of course, we know that $1.75 is on a per share basis. The total premium you receive is $175. So now you have a position on your long shares and you're short a call. That's a covered call position. We want to now draw our P&L graph. This is something I encourage everyone to learn and be comfortable doing. Drawing a P&L graph allows you to visualize where your risk and reward is and analyze the trade more effectively. We're going to start to do that by constructing a simple chart. This only entails easy mathematics, simple addition and subtraction. We're going to choose stock prices at expiration on the left, and then we're going to calculate the profit and loss to end up with a result on the right. We're going to choose our stock prices conveniently. First of all, we'll start with the entry point on our stock, which is $52. If the stock expires, at the option expiration, if the stock is at 52, then we have experienced no gain or loss on our stock position. It ended right where it started. Our call option will have expired out of the money. There'll be no intrinsic value at that point. Of course, there's no time value because we're at expiration. We sold this option for $1.75, so that's $1.75 profit for us on the call. Add those two together, and we get our net profit on the position of $1.75. So here's a quick example of how you've generated additional income. If you own the stock, you gained nothing. You broke even. You have a covered call on, you gained $1.75. That's positive for you. So now we'll continue to construct our chart by picking additional stock prices at expiration. Let's use an example down at the bottom at the stock price of 40. Our stock has dropped $12. So our profit loss on the stock position is a negative $12. Our call option is now far out of the money. That expired worthless just as it did before. We sold it for $1.75, so that's still $1.75 profit for us. Add those two numbers together, and we have a loss of $10.25. As you continue to move lower in stock price, 30, 20, 10, on down the line, you will notice that your net loss on the covered call will continue to get worse, but that $1.75 will always be there. So your loss on the covered call, although it gets worse, will be $1.75 better than your loss would have been if you just owned the stock outright, and that's to the downside. Now let's take a look at the upside and pick the top stock price here as an example. $60 at expiration means the stock moved up from 52 up to 60. That's an $8 gain on our stock position. Our call is now in the money. It's in the money by $5 full. We don't own this call, so that's not a positive 5 for us. We sold it or short it. That's a negative $5 for us. But remember, we sold it for $1.75 to begin with, so the net loss on our call option is $3.25. Put those two numbers together, and our gain on the spread is $4.75. Notice here the stock moved up by 8. If you just owned the stock, you would have gained $8. Your call worked against you, and your net profit on the covered call was only $4.75. But you knew that going in. You knew you'd have to give up your shares at 55, and you were comfortable with that. If you chose higher stock prices at expiration, say 70, 80, or 100, and ran these calculations, you would come out with that same $4.75 net gain on the right. So there's our chart. Now we can put the graph together and visualize our P&L. Here you have the long stock in a dashed line superimposed, and of course the covered call in the solid line. Now let's take a look at our break-even point. You notice it's better for the covered call than it is on the long stock, of course, because if the stock moves lower by $1.75, we would experience a loss of $1.75 on our stock, but a gain of $1.75 on our call option. So the break-even point is your entry point on the stock, which is 52, minus the call premium received, which is $1.75, or $50.25. That's a better break-even than you'd have if you were just long the stock. Now, visualizing this, you can see the covered call outperforms the long stock position if your market outlook is correct in that neutral to slightly bullish area. In fact, it outperforms to the downside too, but those losses can mount up for you. So that's not really regarded as a benefit of the covered call. Right in that neutral to moderately bullish area, you have added gains and added returns for your portfolio with the covered call. And then we know the limitation. If the stock skyrockets higher and you just own shares, you would experience large gains. But the covered call limits you somewhat. You can't participate past the strike price because you have to sell the stock there. You're obligated to do so. So the call profit, the covered call profit to the upside flattens out. Now, one of the most common questions we get here at the council is, which option do I sell? Do I sell an in the money or an out of the money? How do I figure that out? And of course, there is not a right or wrong answer. What I'll point out here is that what you're trying to capture when you sell the call is its time value, its extrinsic value. And the reason why I say that is, it's common for us to get questions from people who say, look, I see these in-the-money call options, and the value of the option is so high, it's so great, I want to use in-the-money calls within my covered calls. I want to sell those because the premium is greater. But you have to keep in mind that intrinsic value of the option doesn't really help you much. And I'll just give you a quick example. If you were to buy shares at $50 and sell an in-the-money call, say at a strike price of $40, that intrinsic value is $10. If you sold an option for $10, if you sold that $40 call option for $10 and thought, wow, that's $1,000 in my pocket, that's a lot of money for myself, what happens if the stock stays unchanged all the way through expiration? You'd be assigned. You'd be under the obligation to sell your shares at 40. Bought them at 50, you sold them at 40, that's a $10 loss. That option premium you received of $10 was just canceled out and you make nothing. So what you're really interested in here is selling extrinsic value. If you're looking at in-the-money calls, you'd want to do that quick, easy computation in your head. How much intrinsic value is there? And then determine what added value is there. What extra can I get above that intrinsic value? And that's the extrinsic value. That's what you're really looking for. What you'll see if you compared these two, and if you really wanted to, I would encourage you to draw the P&L graph like we just did. What you'd notice is that the in-the-money call option within the covered call spread is more conservative. Your break-even point is lower, but your potential gain is much less. And that's because you don't have the ability to profit if the stock moves higher. So it's considered more defensive and more conservative. An out-of-the-money call, on the other hand, would give you that opportunity to profit if the stock moved higher. There's less premium that you receive, so your break-even point is higher. That works against you, but you can make more money. So the decision between in the money or out of the money boils down to how aggressive you are with the trade, how confident you are with the trade, and then you determine which route you want to go. Now we're going to do another example here, and this one's going to stick with us for a while. We're going to do a couple different things here, and it'll lead us into our return calculations, which is very important to understand. But we're going to start with this slide. Off on the right side, we have stock XYZ at this time trading at $43.50, and we've done our analysis. We've looked at the market and listened to the people we listen to and done the kind of analysis we like to do and determined that we think XYZ is going to stay between $40 and $45 over the course of the next few months. Now, if we just bought the stock at $43.50 and our forecast is correct, that the range holds true, we're looking at possibly a $1.50 profit with a potential loss of $3.50. That risk reward doesn't really work out too well for us. But if you put on a covered call trade, that might change things. So we'll take a look at that. If we sell a call option, we may lower our break-even point. So we're going to buy shares at $43.50 and go through an example of selling these October 45 strike price calls at $2.30. October's 80 days out. That's consistent with our forecast. We're selling a 45 strike price call. We don't think the stock's going above that, so we execute this trade. Now let's take a look at that. What does our position look like now? We own shares and we're short a call. We have a covered call option. Now we're going to add a detail here, a wrinkle of XYZ paying a dividend in about a month's time. Keep that number in mind. It's going to come into play and it'll pop up in our return calculations. But the first thing we're going to do is just sort of rehash what we did with our first example and go through a P&L graph and then a chart of this particular spread example. So we have our dashed line, of course. The long stock has losses at the entry point of $43.50 and gains above the entry point on the stock of $43.50. And our covered call has a different look to it. Break-even point is lowered. So if we bought the stock at $43.50, we could tolerate a move lower in the stock of $2.30 because we stand to make that on the call option. So our break-even point is now $43.50 minus $2.30, which equals $41.20. Now remember what our forecast was. We think the stock is staying between 40 and 45. If we're correct, we now stand to gain $3.80. And again, if we're correct, we're looking at a loss of about $1.20. That risk reward looks a whole lot better. So this trade looks a lot more enticing than just buying the stock. Of course, you have to keep in mind that $3.80 potential is the max. That's as much as we can make, whereas that $1.20 loss isn't the max. If we're wrong and the stock moves lower than that, we would experience more losses, even though those losses wouldn't be as great as we would if we just owned the stock. So now we'll go through our chart again, and we're going to pick the entry point to start with. $43.50 at expiration is where our stock ended up. This means we haven't gained or lost anything on our stock trade. That's zero. Our call option expired out of the money, worthless. We received $2.30, so we kept $2.30. That leaves us with a net profit of $2.30. On the downside, just as before, if the stock moved all the way down to $30, that means the stock moved down by $13.50. That's a loss for us. We own shares. We lost $13.50. The call option now is even further out of the money. It's worthless. We received $2.30 for it. Put those two numbers together, and our net loss is $11.20. Again, as you move lower in stock price at expiration, your loss on the stock will continue to get worse. Your profit on the call will stay at $2.30, so your net loss on the covered call will continue to get worse, but it'll always be $2.30 better than the loss on the stock. On the upside, let's take a look at $50. What happens if the stock goes up to $50? That represents a $6.50 move higher for us in the stock position. Our call option is now $5 in the money. We're shorted. That's a negative $5 for us. We received $2.30 to put the call on to sell it. So our net loss on the call is $2.70. The stock plus the call in profit and loss terms leaves us with a profit gain here of $3.80. If you chose higher stock prices, you'd see your stock price, your stock profit gain. You'd see your short call loss also increase. They would cancel each other out, and all the way up at a stock price of 60, 70, 80, 100 would still yield a net profit of $3.80. That's your maximum. Now we're going to take this to the next level, and we're going to get to return calculations. Let me talk about this for a minute before we get into it. We're really going to do two things here. Before we get into complicated numbers, we're going to use simple ones. When you do a return calculation, the first thing you're doing is calculating the return on the specific trade, and then You're translating that return into an annualized number. That's all we're doing. So for example, if you invested $100 and you earned a profit of $10 on that trade, that's pretty simple. You earn 10% on your money. Now, in order to annualize that number, you have to figure out how many times could I have done that trade to cover one full year, consistently, constantly throughout the entire year. If you invested $100 and profited 10 and it took you 6 months to accomplish that, then theoretically, you could have done that exact trade 2 times in an entire year. Earning 10 the first time, earning 10 the second time would leave you with an annualized profit of 20%. If you invested 100 and made 10 and it took you 3 months, then you could have earned that 4 times to cover a full year. So 10% times 4 would give you an annualized return of 40%. That's all we're going to do here. The numbers are going to be a little less clean than that, so hopefully you can follow through. Here's the mathematics behind it. We're going to start doing this with an assumption that the stock price did not change through expiration. This is called the static return, static referring to the stock not having moved. And the first part on the left is calculating the return on the trade. How much did we make versus how much did we invest? In our case here, we received call premium, that's income for us. We received a dividend payment, that's income for us. The stock didn't change, so we didn't make or lose anything there. So our income is call premium plus dividend. Our investment is how much did we pay to do this trade? We bought shares of stock. We paid for them. So our capital investment is the stock price. So using those numbers, we're going to be able to figure out what our profit was in percentage terms on the trade. And then we're going to multiply it by a time factor to figure out what the annualized return is. So we're going to go through those numbers top to bottom. We know that our call premium that we received was $2.30. That's income for us. We said that we received a dividend payment of 18 cents. You put those two numbers together to get our total income on the trade of $2.48. That's what we made. That was our profit. How much did we commit? That's our stock price. What was our capital requirement? $43.50 is what we paid. So we earned $2.48 off of an investment of $43.50. What percent return is that? Well, that's simply $2.48 divided by 43.50 or 5.7%. We earned 5.7% on the trade. That's valuable and useful. Now we want to annualize that number. The purpose of annualizing is so you can compare trades to each other. This might be the result of trades you've made, or you might be comparing annualized potential returns of trades you're thinking about doing. They're all going to have different time frames and different numbers. So in order to compare apples to apples and compare them to each other, you might want to see annualized returns for all of them so you can compare them equally across the board. Now, we said the trade earned 5.7%. And it lasted, if you remember, 80 days. So the question is, how many times could I do this trade to cover a full year? If I did it for over 80 days, and a full year is 365 days, that means I could do this trade, in theory, 4.5 times and earn 5.7% each time. So your annualized return here would be 5.7% times the 4.5 times you could theoretically do this trade to give you an annualized return of 26%. Now we're going to go through this calculation again because it's important. You're going to do a lot of it. We're going to do it again, but with a little bit of a twist, a little wrinkle here. This is going to be titled the if called return, which means the stock got called away. The stock price rallied, went through our strike price, and we were assigned. So we sold shares at the strike price of the option, and now we have a gain. We entered the stock at $43.50. Our strike price was $45, so we actually profited $1.50 on the stock move by being assigned. So you see the numerator on the left side has changed a little bit. The income is going to stay the same. That's our call premium. We received that. That doesn't go away. We still received the dividend because we're a shareholder. But now we have the added benefit of having gained on the stock price move higher, specifically by the strike price we sold it at minus the stock price we bought it at. And then everything else remains the same. Our investment is the stock price, and then we multiply it by the time factor to get the annualized number. So we'll start at the top. The call premium was $2.30. We received that. We received an 18-cent dividend. Our profit on the stock this time around was $1.50 because we actually had to move higher in the stock. So now our total income is all three of those components, or $3.98. Our investment, or the capital we put up, was the stock price, $43.50. We bought shares, we paid for them, and that was our capital investment. So now if you do the division, 3.98 divided by 43.5, you come up with 9.1%. We earn 9.1% on this trade. We're going to annualize the number. It was the same trade, same 80 days to expiration. So in theory, we could do this trade 4.5 times to cover an entire year, earning 9.1% each time. So to annualize the number, we take 9.1%, we multiply it by 4.5, and we come up with a return of 41%. That would be the annualized return if we're called away on the example we gave and sold shares at 45. Now we're going to do a little comparison between the static return and the if called return, specifically with regards to which option you sold. Now let's think about at the money versus out of the money. An at-the-money call option, of course, has a lower strike price. Therefore, the premium is a little bit higher. The negative to selling an at-the-money call is that you can't participate in a stock move higher. You're under the obligation to sell shares right where you bought them. You received more premium to do that, but you have to sell your shares right there. So if the stock doesn't go anywhere or is consistent with the static return, your at-the-money or closer to the money call option will return you more than an out-of-the-money option would, because the out-of-money option offers you less premium, offers you a little less protection. What the out-of-the-money option does is it gives you the possibility of profiting on that stock move higher. So it's a little more risky, a little more aggressive, and that's the difference between the two. The reason to point this out is if your forecast is not just neutral to moderately bullish, but a little more fine-tuned than that. Let's say you are really neutral. You don't want to give up the stock. You're going to earn a dividend payment, but you really don't think the stock is going anywhere. Then you might lean towards selecting a strike price that's closer to the money, so you can receive added premium and not have to give up much because you don't think the stock price is going higher anyway. On the flip side of that, if you're leaning more bullish, say you're less neutral and you're more slightly bullish, then you might lean towards selling an out-of-the-money call option because that gives you the opportunity to profit on the upside with a stock move higher. So there's a difference between static and if called, and it highlights what the difference is between strike prices that you sell and may give you some insight and help figuring out what strike price you want to incorporate into your covered call trade. Of course, like any position or any trade you do, you have to prepare yourself for what might happen during the lifespan of the trade. You have to consider different possibilities and think ahead and prepare yourself for what are you going to do if different things happen. Of course, the stock can go in three directions. It can go up, down, or sideways. So we're going to look at all three of these, and by no means are any of these choices that we provide right or wrong answers. They're things for you to think about and things to analyze when the trade is on to help you manage the position appropriately. So first of all, what if the stock price goes higher and it goes through your strike price of $45? What do? You have several choices here of things you can do. First of all, you might just do nothing and allow the exercise assignment process to take place. This would happen if you're just willing to sell the stock, exit the position, and move on to the next trade. You'd experience your maximum gain or maximum profit if this occurred, and then you can just decide where else to allocate your funds. The position would be taken out of your account, you'd deliver the shares you'd owned, and then you can move on to the next trade. If your forecast changed, on the other hand, and you decided that you were now very bullish in the underlying, you're no longer neutral to moderately bullish, you're aggressively bullish. You think the stock's going higher and you want to participate in that move. Choice B says you could buy back the call and keep the stock. Now, the price you buy back the call at is going to have an effect on your decision for sure, but you might be buying it back at the same price you sold it, or maybe even a little less, or maybe more. It depends. But the price will factor in, and you will determine if you want to do that, pay that cost to get the added benefit of owning the stock and being able to participate in a continued move higher. So if your forecast shifts and you become very bullish, this would be an appropriate way to manage the position. Choice C will be to close the position proactively by entering a closing order into the market. You would do this by buying back the call and selling the stock. This would occur if you wanted to eliminate your downside risk. While this trade is on, that downside risk is still going to be there. So if you become bearish or concerned about a move lower in the market, you might consider just going into the options market and closing the position out. Also, if you price up your covered call spread and notice that you could close the position out for very close to your maximum potential gain, that might be another piece of motivation to close the position out. You've already gained as much as you could, very close to as much as you possibly can, so you don't want to take the risk of a downside move for the possibility of slightly more gains, and that might be motivation for you to just go ahead and close the position out. Now let's take a look at scenario number 2, which would be the stock doesn't go anywhere. It stays right where it is. If the stock is unchanged at expiration, well, this one's a little more simple to look at. You have several choices really here. First of all, you could write another call. You're left with a long stock position. That's what you have in your account. You're just long shares. So if you're still neutral to moderately bullish, you could write another call option and reintroduce the covered call spread again. You could also sell the stock. Maybe you're not sure where the stock is going here. Your market analysis has been distorted. You're not sure where it's headed, or maybe you've become bearish, in which case you'll just go ahead and take the profit that you were able to capture on the initial spread, sell the stock, and move on to the next trade. You also could hold the stock. Again, if you become bullish and you think the stock is going higher, you could hold onto the stock and try to take it for a ride higher and profit that way. The third scenario would be if the stock moves lower. And this is the tough one. This is the difficult one because now you're talking about experiencing losses. And what do you do if things move against you? It's always a difficult trade to make and generally regarded as one of the toughest trading decisions to execute a closing transaction for a losing trade. It takes discipline, but it's necessary. Now, none of these choices are wrong. If the stock moves lower, you could write another call. If your original call expires worthless, but you're still genuinely neutral to moderately bullish and you want to recapture some of those losses, you could write another call at a lower strike. If you've become very bullish because the stock's now trading lower, you could hold the stock and look for it to turn around. Those are certainly not wrong answers, but you are always well advised to have a predetermined stop loss, know what your maximum loss can be, what your risk threshold is, and then have the discipline to get out of that trade. So it's not an easy trade to make, that exiting for a loss trade, but sometimes you have to. When you've reached your breaking point and you can't afford to lose more, that's a point in time where you might consider doing this. Now, I'll point out something important here with regards to execution of choice number C here. A lot of options accounts have approval to trade the covered call spread, but don't have approval to hold a naked call. So if you wanted to exit, let's say the market's moving against you, it's selling off at a quick pace and there's panic and you want to get out of your position, you could not sell the stock leaving yourself with a naked call position. What would happen if you tried to just enter an order to sell shares is your order could get rejected, because the result of selling that stock would leave you with a position that you're not authorized to have. Now, if you're authorized for the naked call, that wouldn't apply, but a lot of people aren't. The naked call is one of the most risky trades you could possibly have. So that's at the highest permission level. So keep this in mind. It sounds simple and easy, but people tend to panic when markets move fast. And if you're experiencing losses and you have some covered call trades on and you want to get out of your positions before they experience more losses, keep in mind that you might not be able to just enter an order to sell your stock. You might get rejected. And it can throw you off because you're getting a rejected order to try and sell shares that you own. The reason is you can't be left with the naked call option because you don't have permission to have that position on. So keep that in mind if you're in this unfortunate circumstance of having to sell shares in a fast-ward down-moving market. Now, we said you need to have a plan. Of course, you want to have a strategy in mind. You want to find a stock that fits the forecast of the covered call. That means a neutral to bullish outlook on the underlying. And you want to decide what kind of call option you want to sell based on your forecast. How aggressive do you want to be? Where are you comfortable with your break-even point being? How much do you want to limit your potential gains? So keep all these in mind, have a plan, and then go ahead and execute that plan. What you want to do is be willing to sell shares at the stock price, have a stop loss in mind like we talked about, and then diversify. Look for different symbols and underlyings. Now, the last section we're going to talk about here today is misconceptions about covered calls. There's 4 of them we're going to go through one by one, and we'll pick apart those in a little bit. And if you haven't heard of these before, you're likely to hear of them sometime soon here. First one is that being assigned is bad. That's a misconception. Some of you may already think or realize that really isn't a bad thing, but we hear this sometimes. People come across and think that since they have to give up shares that they own, that's a bad thing. But now think about what your initial goal was. In fact, there are a lot of covered call investors who think that being assigned is a good thing because their intention going into the trade was to capture some upside movement, capture the option premium, and then be assigned, get rid of the position, and move on to the next trade. So there are plenty of investors who don't mind being assigned at all. So this is really a misconception that forms from not tying in together what your goal was and what you accepted with your obligation to what the result was. So it really isn't a bad thing to get assigned. It's profitable, and it gives you the opportunity to move on to the next trade. Misconception number 2 is that most options expire worthless. Therefore, selling covered calls is good. Selling options is good because options expire worthless. Well, that's a widespread thought. Not sure where it comes from or where the stats come from, but it really isn't true. The fact of the matter is most options are traded out through a closing transaction in the options market. So if you buy an option, you would sell to close back to the options market. Or for options writers, they buy to close back in the options market. Most options positions are closed that way. And of course, some go through the exercise and assignment procedures. And then here you see roughly about 25% of options that are purchased are held through expiration and expire worthless. So this is not a motivation to do the covered call. Instead, your motivation is to outperform your stock position in a sideways or slightly upward moving market, to possibly target your selling price, which would be your strike price. If you want to sell the stock there, you can sell a call option and get paid premium along the way. And of course, you've lowered your downside potential loss. You've lowered your break-even point by the amount of the premium, all of those benefits. That's why you do the covered call, not because most options expire worthless. Now, misconception number 3 here, this one drives me a little crazy. Sometimes people tend to say that writing covered calls forces you to sell winning positions and keep losing positions. And of course, that can happen if you do absolutely no money management whatsoever. You don't follow the markets and you don't do any position management. If you completely fall asleep on your trade, you could end up like this. Put some covered calls on, don't pay attention to your account for a year, go back and look in your account and you see that the stocks that performed well were sold off at the strike price and out of your account, and the stocks that depreciated and didn't do well are sitting in your account at losing positions. Of course that can happen. If you're a loser investor, that's what happens with people that don't pay attention to their trades. But options investors are not like that. Options investors are savvy. They pay attention to their trades. They update their analysis, and then they make position adjustments when necessary. We talked about some of those position adjustments earlier. Of course, if the stock's moving against you, you have a stop loss, you get out, you move on to the next trade. If your market outlook has changed and it's no longer consistent with the covered call, you make the appropriate changes. So you actively manage your position to avoid misconception number 3. If anyone says that this spread forces you to sell winners and keep losers, that's someone who doesn't know how to manage a portfolio, and options investors, generally speaking, are much more smart than that. So hopefully you won't fall into this category. Now, the last misconception here, number 4, I like this one. This one makes sense, and we get questions about this a lot. The larger the premium, the better. Some people writing covered calls think that because the premium is so great and the potential annualized return is so great, then the trade must be better. And I'm not saying it's not better. It certainly could be. But keep in mind, the market is efficient. If there are higher premiums and higher potential annualized returns, that very well could mean that there's more risk involved with the trade. Inevitably, sooner or later, you're going to price up some covered call option, maybe on a symbol that you're familiar with, and you're going to see that the annualized return potential is huge, and your eyes are going to light up, and you're going to want to be all over this trade. And then when you dig a little deeper, you'll see that the option you were pricing up expires in 14 days, and the stock is announcing earnings in 12 days. So there's a huge market-moving event occurring right before the option expiration, and that's why premiums are high. You will see that kind of thing happen and realize, yeah, it's great premium, great return, but there's higher risk. That doesn't mean don't do the trade. You might be bullish on earnings. You might be bullish on the stock and want to capitalize on that high premium amount. But on the surface, larger premium doesn't mean better trade. In fact, the lower premium might be the lower risk trade that you're more comfortable with. That's certainly possible too. So if you see higher premium, I'm not going to say not to lean that way, but certainly look deeper and analyze the risk component before you make a decision and take that higher premium trade. Now we're just going to summarize everything that we talked about here today. This covered call strategy is appropriate for a neutral to moderately bullish stock outlook. We've said that 10 times today. You'll hear it in your sleep tonight. You're looking to increase your income in a stable to moderately higher market. That's by the call premium you receive. You know that you're limiting your profits on the upside. You accept that to sell the call option and receive the premium, so you can't participate in a large move higher. You understand it. You're willing to take that on. And you also know that your risk on the downside is similar to that of owning stock. It's a little bit better, but it's similar. So you know you have to have some kind of risk management technique underway and plan ahead in case that happens and the stock price moves lower. What do you do? So you have to plan ahead. So that really covers the presentation here today. I would encourage you to check out our website, optionseducation.org. We have an assessment on there you can take, which will guide you through the website and help you develop a curriculum for yourself. We also have a long list of videos and podcasts that you can learn from. And of course, these presentations, we're doing more webinars this year, and we're going to have a whole bunch more next year. That's very useful. So I encourage you to check out the website and get as much use out of that as you possibly can. There it is, optionseducation.org. And don't forget the ease at which we offer our services through the mobile app. And then, of course, our YouTube channel, which has certainly a nice healthy list of archived, taped presentations that we've delivered. So that was our presentation for today. I hope you all enjoyed it. I enjoyed delivering it. And Nick, I'll bring you back on to start wrapping things up.
Absolutely. Thanks so much, Ed. And we do have a few questions for you, but before we get to those, I want to remind our listeners that, as Ed mentioned, if they have further questions about the concepts that Ed discussed today or any of the tools on the OIC website, such as our position calculator, and if we weren't able to get to that question that you submitted to us, you can always contact Ed or the other members of the Investor Services team at options@theocc.com. They're ready to help answer your questions about options strategies or positions. Additionally, as we both mentioned, our session today will be archived and accessible in a few hours using the same link you used to join us today. And make sure to check out our YouTube channel. Just go ahead to YouTube and search for Options Industry Council, and you'll be able to find a number of option strategies from previous webinars that you can review at your own pace. So Ed, with that, let's jump into the questions. And the first one, I think, is from a little bit more of an experienced trader. And this investor wanted to know, can you do the covered call strategy when you're using leaps?
You certainly can. There's certainly a circumvent to owning the stock position would be to own a leap option. Some people think that that's a better way to approach things. Your cost could be a little bit less. So if you, say, bought a in-the-money leap option and then started selling shorter-term call options against it, you would still be able to capitalize on the spread as its function, and the risk-reward would be similar. So really, you could do that for sure. And the leap option that you buy would just be intended to emulate the stock position that you would instead own, but be a little bit different because you now have a lower cost. But the functions of the spread would be similar, so you certainly could do that.
Ed, how are trailing stop orders handled on covered calls?
Well, it's a good question for your broker. Every broker may handle that a little bit differently. Trailing stops certainly would have a trigger point. You'd have to find that out from your brokerage. What kind of trigger point can I use? Is it on the stock price? Is it on the spread price? And maybe have some flexibility there. So certainly that's a really good question for your broker. They may handle things differently and have different functionality. So if you were interested in finding out what kind of exiting orders you could place, I certainly would encourage you to reach out to your broker, find out a little more about their platform, practice with it, and see if they can give you some heads up on how to exit the trades with the trailing stop.
And if the buyer of a call exercises the option, do the shares then end up in the buyer's account?
Well, if the buyer of a call exercises their option, then yes, they would be purchasing shares, and the shares would end up in their account. Now, on the flip side of that, if you are short the call and you're assigned, you're delivering shares. You would be short shares if it was a naked call. In our example here, you already own the shares in the covered call spread, so if you are assigned, you deliver the shares you own, and you would have nothing. But I think the question was coming from the perspective of the other side. Does that buyer who exercised end up with the shares? And the answer is yes, provided that they don't have any other position on. You certainly don't know for sure what other positions they may have in their account, so you have to take that into consideration. But assuming nothing else, the answer to the question is yes. The buyer of the option who exercises against you would then end up with the shares in their account.
Ed, is rolling a alternative strategy when you're looking at covered calls? Would that be appropriate when you're dealing with these?
Yeah, it certainly is. This would be similar to our scenario 2. Say if the stock price went unchanged, we said you could sell another call option. That would be if your call option expired, worthless, and now you were left with long shares. You could think about selling another call option. Well, you don't have to wait that long. If the call option that you're short, that you sold, has dropped down in value far enough, say to just a few pennies, you might decide it's really not worth staying short this call because I don't have much left to gain out of it. If you came to that conclusion, then one thing you could do is, like you said, roll it, which would be buying back the call you're currently short and selling another call further out in time, maybe at the same strike price or maybe different strike price. Rolling out is nice because you have some flexibility there. You could execute that separately as 2 transactions or as 1 transaction, but when you roll it out, you certainly could choose different strike prices and different lengths of time to expiration. The direct answer to the question is absolutely. Rolling out your call option is very common. We hear it about a lot, and it's certainly a viable solution towards managing your covered call spread.
Ed, this question isn't specifically about covered calls, but are income from options taxed at the same rate as dividend income?
Well, it's a good question. Tax questions always are a little bit difficult to answer. We have some information on our website through a taxes and investing brochure, but tax laws and tax implications change a lot. So unless you're a licensed tax advisor or an accountant, which I'm not, it's really tough to answer the tax implications. So I would encourage you to do a couple things. First of all, like I said, Taxes and Investing is a brochure on our website that was drafted some time ago. You can review that. Or if you can't find the specific answer to your question there, brokerage firms tend to have some familiarity with taxes, so you can reach out to them and through your broker or maybe on your own, find a financial accountant or a tax advisor who can help you out there. Difficult question for me to get too specific on.
Thanks, Ed. And we do have one last question before we start to close out today. And what do you think about employing the covered call strategy in a portfolio full of stocks that you really do want to keep? Do you think it's appropriate for that?
Well, that's a really good question. You're taking on the obligation to sell your shares, which means to a certain extent you have to be willing to give up your shares. If you really don't want to sell your shares, there are a lot of investors who still use the covered call to increase their income. You would have to be really confident in your opinion of the underlying to not cross above your strike price in order for you to avoid selling your shares. Now, you know that if assignment does happen, you could buy your shares right back. Or if the stock starts to move higher and you're concerned about getting assigned, you could buy your call option back. Doing one of those 2 things might cost you a little bit. You may have to pay up to buy that call back, or you may have to buy your shares at a higher price and give up a little profit in between. That might be worth it to capture income from the covered calls time and time again. The answer is yes, you can do it. You'd have to watch the market a little more closely and be careful to not be assigned if you really didn't want to sell your shares. Buy back the call if you have to, so you don't have to worry about assignment. Repurchase your shares if you are assigned, and you can buy back the shares at a similar price to where you sold them. So the answer is yes. You can increase your income that way. You just have to be a little more careful, and maybe at some times, worst case scenario, give up a little bit of price to get your shares back.
Thanks so much for your time and expertise today, Ed. Do you have any closing thoughts for our listeners today?
Yeah, I wanted to mention something here. I think it slipped through when I was giving some commentary. We talked about the importance of having a market opinion or market outlook and then finding the options trade that fits that narrative. And one thing I wanted to point out was that the covered call is so popular. There are investors who do this trade as a very routine part of their trading in the portfolio. You could actually do that from a slightly different perspective. Instead of having your market outlook and then finding the option spread, of which the covered call is one of them, you could have the covered call in your arsenal as a spread you want to do, and then find underlyings that fit the narrative of neutral to moderately bullish. So same kind of approach, but just looking at it from a different angle. I wanted to point that out because it's certainly beneficial to be familiar and comfortable with certain options trades and certain spreads, and the covered call, amongst some others, might be one of those trades for some of these investors out there. And if that's the case, then you can target underlyings that fit the narrative of the covered call and then put those together. Look, by and large, the covered call is a conservative strategy. You know you're under the obligation to sell your shares. You can target your selling price. It's important to manage the position, know your downside, like we said, exit appropriately, know what your risk threshold is, and be disciplined to get out of trades and move on to the next trade. We've all been there with that losing trade where you got out at the worst possible point and then the market turned around and went right the way you thought. It happens to all of us. But what you have to keep in mind there is that two things. First of all, you had the discipline to get out of the trade. That's going to pay off in the long run. And the other thing is, there really was no way for you to know that that market was going to turn around. The problem wasn't with your exit point. The problem was with your entry point. You put yourself in a position where you couldn't take any more loss, your risk was maximized, and you had to get out. So if you're going to blame anything on that situation, don't blame your exit and then adjust that. Blame your entry points. Work on that so you don't get put in a position next time where you lower your likelihood of being put in a position to have to exit the trade at a bad price. So keep all that in mind. Again, use our website, use the materials we have, and we hope to see you all at our future events.
Ladies and gentlemen, thank you for your time today. And while we weren't able to get to all of your questions, we do have Ed and our investor services team ready to help, and you can reach out to them at options@theocc.com. Many of you also asked about further education. Please visit optionseducation.org, the OIC's website, and look at the Getting Started section for further reading. As I've mentioned, today's session will be archived and accessible in a few hours using the same link you used to join us today. And if you're interested, you can look at the OIC YouTube channel to review previous webinars and concepts at your own pace. And of course, make sure to check optionseducation.org in the upcoming weeks for our next online sessions. Our next webinar will be held on November 17th, when we're actually having another discussion on covered calls. And then on December 1st, we'll be having a full day session on the topic of ETFs, or exchange traded funds. As I mentioned at the beginning of our session, OIC has a few live events left in its evening seminar schedule. So tonight, if you're in Costa Mesa, California, or in Edison, New Jersey, we have sessions in your city. And tomorrow night, we have our final session for the 2015 season. It's going to be on options trade management in Bellevue, Washington. You can sign up at optionseducation.org. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.